the Fed lowered the Fed funds rate by 25 basis points and penciled in 2 more reductions this year. So here the question is, will stablecoins revamp the entire global payment system? And can it do so when the largest stablecoin company, Tether, is not US based, is unregulated, and could potentially cause enormous reputational damage to the entire industry? So let's start. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. This is for the week ending September 19th, 2025. In the news, a New York judge dismissed state terrorism charges against Luigi Mangione in the shooting of United Healthcare CEO Brian Thompson, citing legal insufficiency. The focus now shifts to the remaining murder and weapons charges. Mangione has pleaded not guilty. I bring this up because on Monday, I am dropping a podcast where I do a very deep dive on United Healthcare to separate fact from fiction and to find out what is the real situation at UNH. And there is a real potential scandal. My guest, Michael Ha, was at the very same conference as Brian Thompson on the day he was murdered. The other important news I really want to discuss is the assassination of Charlie Kirk. Mr. Kirk was murdered while he was debating politics with students at a university. It's what he did all the time. I watched many YouTube videos of him doing it. And you could agree with him or disagree with him, but he was always engaging and polite. He was trying to persuade, and he was killed for it. It shows how incredibly polarized our discourse has become. People have come to believe that words they disagree with amount to a form of violence that can be met with real violence. And the crazy thing is that when you go on market-oriented Reddit boards, you will often find similar incredible levels of emotion and anger and rage at certain companies or people. Tesla, GameStop, just to name a few. The hate that can be spewed over such market-oriented topics is incredibly intense, and yet it rarely spills into any kind of violence whatsoever. Why? Because in the end, there is a final arbiter that everyone concedes makes the final decision, and that is the market. You may hate Elon Musk, or hate GameStop, or think that what is going on with Open Door is insane, but in the end, the market will decide who is right, and you see that on your screen every day. There is no outside arbiter in politics. And so because of our polarization, the debates never end and have now seeped into violence as a form of political discourse. I hope we can pull back, but it's hard to put that terrible genie back in the bottle. In the only important business news of this week, the Fed lowered the Fed funds rate by 25 basis points and penciled in 2 more reductions this year. In his press conference, Chairman Powell pointed to growing signs of weakness in the labor market. The vote was 11-1 to cut by 25 basis points, with the new governor, Steve Eisman, dissenting, preferring a larger half-point cut. Since in September, news tends to be slow, today, and for the next few weeks, I'll focus on one big theme. And today, it's stablecoins. The big operative question is whether stablecoins are going to become the next big new thing in payments. Now, why do people think that? Because there have been so many new things. Amazon conquered retail. Netflix remade the entire media landscape. Tesla upended the auto industry. The list goes on and on. So here the question is, will stablecoins revamp the entire global payment system? And can it do so when the largest stablecoin company, Tether, is not US-based, is unregulated, and could potentially cause enormous reputational damage to the entire industry? I will discuss the risk from Tether at the end. Let's first explore how stablecoins work and what is the opportunity. I've scheduled an interview for November with a sell-side analyst specializing in payments, and we will explore these themes then even more in depth than I am doing so today. So let's start. The reason why stablecoins are suddenly so topical is partially because Circle Internet Group went public and has done exceptionally well. It went public on June 4th, 2025 at 31 and is now $140 and has a market cap of $35 billion. So what's a stablecoin? A stablecoin is a form of cryptocurrency, but of a very particular kind. It's hard, and I would argue impossible, to create a payment system around Bitcoin, for example, when the value of Bitcoin can fluctuate wildly on a daily basis. Payment systems require certainty and stability, and that is where stablecoins come in. In a stablecoin, the user buys a stablecoin from an issuer, in this case, Circle. So let's say you buy $1 worth of stablecoin from Circle. Circle's stablecoin is called USDC, and Circle takes that dollar and invests it in short-term US treasuries. More on this later. The value of those investments do not fluctuate. I can say that again. The value of those investments do not fluctuate. So the value of the USDC is stable, and that is fundamentally crucial. The owner of the stablecoin must have confidence that the value of the stablecoin won't change. The buyer of the USDC can then use that stablecoin for various kinds of payments. Now, this technology is still in its infancy, and much of the validation of integrating stablecoins into traditional finance has yet to take place. How Circle makes money is something we will discuss later. But first, let's look at its current use cases and potential future use cases. First, realize how incredibly tiny this market still is. Circle's USDC amounts to only 6 basis points of global M2 money supply. 6 basis points. But it has the following use cases and potential use cases. 1. Digital asset trading. Because stablecoins are pegged to the US dollar, USDC is a reliable way for traders to convert their positions in cryptocurrencies into a stable currency. 2. Dollarization. In regions where there is hyperinflation or political instability, USDC allows non-US individuals to maintain their purchasing power by holding USDC. 3. Decentralized finance, aka DeFi. A holder of USDC can earn yield on that USDC in a digital wallet, thereby creating a decentralized savings account that is not FDIC insured. 4. Cross-border payments and cross-border remittances. Using USDC facilitates very cost-effective transactions and allows users to send or be sent money across borders. And 5, the big kahuna, consumer payments. Can stablecoins break into the credit card, debit card payment system? Can it disrupt Visa and MasterCard? Now, as best as I can tell, right now, digital trading constitutes 50% of USDC, dollarization is about 25%, and DeFi is 20%, and remittances is a lowly 5%, and consumer payments are basically zero. Right now, Circle seems to be focusing on expanding USDC into all aspects of the new digital asset trends. And that's fine. There are plenty of opportunities there. But if stable coins are going to be the new thing, it has to break into traditional payments because the size of traditional payments is just massive by comparison. And I would focus first on cross-border payments and remittances. Consumer payments, on the other hand, are huge, but are going to be very difficult to break into, and I will discuss why. So let's talk about cross-border first. The cross-border opportunity. When a US entity pays a foreign seller, the money literally could flow through 3 to 4 to 5 banks before the payment is settled. There is no question in my mind that stablecoins have the potential for streamlining this process and making it cheaper. In fact, stablecoins have the potential to make the cross-border transaction instantaneous. Now, the size of the cross-border payment system is massive. It's in the multiple trillions. The biggest potential market is what's called XB B2B payments, and that means cross-border business-to-business payments. That's when one business is paying another business overseas. The size of this market is huge, around $30 trillion in volume a year. And the next big potential market is XB remittances P2P. This is a fancy way of talking about when money is sent by migrants back to their families at home. Think of this as a substitute for Western Union. And the size of this market is big, but not nearly as big. It's $3 trillion. The opportunity in cross-border is huge, and don't get me wrong, breaking into cross-border will be difficult. The current cross-border system functions. I just think it could function a lot better. And stablecoins have a real shot at this huge opportunity, but it will take great execution. But I think it's doable. Consumer payments is another story. So let's look at it. Now, recently, there have been announcements of retailers like Walmart creating their own stablecoins. And the idea is that stablecoins are potentially a cheaper mode of payment than Visa and MasterCard. And so some investors are wondering if stablecoins will disrupt Visa and MasterCard. It's an important question. We live in an age where new companies, Amazon, Netflix, Tesla, have completely disturbed and disrupted the ecosystems of their industries. And the entrenched entities watched and let them do it every time. But here Circle faces formidable competitors, Visa and MasterCard. Now, how do I know that Visa and MasterCard are formidable? Because I have watched these two companies for decades. And every 5 years or so, a new crop of payments companies show up and brag that they are going to disrupt Visa and MasterCard. I can't tell you how many times I've seen this. And 2 to 3 years later, every time, these same companies show up again and all say that it can't be done and that they are now partnering with Visa and MasterCard. I've seen this time and time again. Visa and MasterCard are formidable companies that continue to adapt to a constantly changing payments landscape. This is not the entertainment industry that allowed Netflix to steal the entire business while they watched. Stablecoins breaking into consumer payments is just plain difficult. Now, the bulls would say that stablecoins can make consumer payments cheaper than the current consumer payments infrastructure. And that could be true, but it is also largely irrelevant. When you use a credit card, the total amount that is taken by the payment system could be as high as around 2.5% to 3%. And that is broken down between the credit card company, the merchant processor, and Visa and MasterCard. Visa and MasterCard, by the way, take only around 15 basis points for a fee. That's it. Now, the consumer pays nothing. The 2.5% to 3% comes out of the purchase price. In other words, the merchant pays the entire fee. So stablecoins, I'm sure, could create a consumer payment system for less than 2.5% to 3%. But so what? The consumer would still pay nothing. Circle would have to find a way to entice consumers to use stablecoins away from a system where the consumer pays nothing up front. It's even more difficult than that. The credit card industry has an entire ecosystem of rewards and cashback that Circle would have to compete with. Go try to compete with American Express or Chase with better rewards. Who has the deeper pockets? That's why breaking into consumer payments, in my view, will be extraordinarily difficult. Cross-border is where they should focus. It may not be easy, but it's doable. Now, there are many other nuances to this business, including distribution costs, but I want to end with the major risk to this industry. The risk involves the source of Circle's revenue. Circle's current revenue is derived from the interest income on the treasuries that are backing the coin. Circle invests this money with BlackRock in a fund devoted solely to Circle. So when the Fed starts lowering rates, that hurts revenue. If short-term rates decline 100 basis points, that could cut Circle's revenue by a double-digit percentage. Of course, if short-term rates rise, Circle benefits. But this is not the risk to Circle. That is just the economics. What is the risk to Circle? The risk is kind of scary, and it rests with its competitor, Tether. Circle is actually the second largest issuer of stablecoins. Tether is larger. Now, Circle is based in the United States. It is regulated by the US. It invests the money it gets from buyers of stablecoins in a fund run by BlackRock. The contents of the fund are transparent. Good for Circle. Tether, on the other hand, is based in El Salvador. It is not regulated by the US. It is unclear how safe its investments are when it says, that is Tether, that its stable coins are stable. Tether provides an audited quarterly proof of reserves, and that proof is not very detailed. Apparently, a not insignificant percentage of Tether's assets are in alternative assets. This all sounds dangerous. Now, perhaps with the passage of the Genius Act, Tether will bring itself more into compliance. But if I was CEO of Circle, I would be worried constantly that one day my largest competitor blows up because they played some shenanigans with their investments and Tether's stablecoin becomes unstable. That would be a terrible scandal and would really hurt the reputation of the stablecoin industry. And now from the mailbag. This is from Manoj, who writes, I thoroughly enjoyed your recent masterclass in finance video. You covered a significant amount of material and conveyed your knowledge in a clear and digestible way. You're welcome. I particularly appreciated your discussion on banks and the connection between the Fed's overnight rate, the yield curve, and banks' net interest margin. That truly was a masterclass. I have a couple of questions based on the video. One, you mentioned that loss-making tech companies are valued using discount cash flow. Now, my understanding, says Manoj, was that these companies are typically valued based on price to sales. Could you clarify if my understanding is incorrect? And number two, your video primarily discussed valuing businesses using price to earnings, or DCF, with the exception of real estate. Could you elaborate on your personal approach to evaluating businesses? So with respect to the first question, Manoj is partially right. When it comes to loss-making tech companies, analysts often use a combination of discounted cash flow and supplement that on occasion with price to sales. Now, with respect to question 2, I want to emphasize that I don't have the Steve Eisman way to value stocks, because in my view, there is no one way to value stocks. Investing is being practical and pragmatic. Now, in financial textbooks, you will just find a description of all the various methods of valuing stocks. What those textbooks don't discuss is this. There are 11 sectors within the S&P 500, and each sector has multiple subsectors. And here is the key point, and I can't emphasize it enough. Each sector and subsector has a mafia composed of sell-side and buy-side analysts and some portfolio managers. How do I know this? I started my career in the 90s at Oppenheimer, which was a brokerage firm where I published research on the financial services sector. That's the sell side. In 2001, I left that job and worked as an analyst covering the financial services sector for a hedge fund, where my research was not published and was used only by the hedge fund that I worked for. That's the buy side. I then moved to FrontPoint, where I was the portfolio manager of a hedge fund specializing in financial stocks. As a result, I've been part of the financial services mafia for ages. The mafia are the sector experts, and through a dialogue between these sector experts over time, a consensus emerges as to 2 crucial issues. 1, what data points matter in thinking about fundamentals? And 2, how to value companies in the sector or subsector. Do you use PE or EV to EBITDA or something else? With respect to valuation, once that debate is settled, it becomes consensus, and that consensus on valuation can last a long, long time. Sometimes it can change, but it takes a lot to change it. So when I look at a company in a particular sector, I accept the terms of debate. How companies are valued within a sector is not determined by me, but by the mafia. I just look at the fundamentals, and if I decide to invest, I accept the valuation parameters as they exist. Of course, with respect to some sectors, I just may not be able to stomach those valuations, so I just won't play. But spending your time trying to convince people that a sector is valued incorrectly is just a waste of time, and that's the wrap. This Monday, we will drop an interview with Michael Ha, the managed care analyst at Baird. We spent the hour discussing United Healthcare to better understand the incredible depth of its problems. I think you will learn things you will not find anywhere else. So please tune in. If you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcast and the financial literacy masterclasses. Subscribing is the best way to help the channel, and we greatly appreciate your support. Also, be sure to check out our website, realeismanplaybook.com. There you can easily access all our episodes as well as the financial literacy masterclasses, and some other surprise goodies we will be posting soon. Check it out, and see you soon. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.